So, you're a civilian contractor working in a combat zone. You've definitely heard the talk, the Barracks Law, that your pay is tax-free. It's a really tempting idea, right? But is it actually true? Today, we're going to tear apart one of the most misunderstood areas of U.S. tax law and get you the real answer. Here's how we're going to break it all down. First, we'll bust that big myth right open. Then, we'll get into the huge legal differences between military and civilian rules. After that, we'll look at a major legal trap that existed for years, how a 2018 law completely changed the game, and then, the important part, your playbook for how to stay compliant, and a warning about some financial dangers that are still out there. All right, let's dive right in and confront this Barracks Law head-on. This idea that just setting foot in a war zone automatically makes your income tax-exempt. This is the question, isn't it? It's the one at the heart of everything. You're out there sharing the same risks, the same sand, the same dangers as the military personnel you're supporting. So it only makes sense that you'd get the same tax break, right? Well, the short, simple, and legally correct answer is no, absolutely not. See, the United States has a very unique system called citizenship-based taxation. And what that means is, if you're a U.S. citizen, the IRS taxes your income from anywhere in the world. It doesn't matter where you live or where you earn it. Being in a combat zone doesn't change that fundamental rule one bit. So this is the most critical thing to understand. Military members and civilian contractors are governed by two completely separate, totally different sections of the tax code. And I'm not talking about a small difference. This is a massive legal divide. And this chart just lays it out perfectly. Look at the military side. Their tool is Internal Revenue Code Section 112, the Combat Zone Tax Exclusion. It's automatic. It just happens. If you're enlisted, every single dollar is excluded. Now, look at the contractor side. Your only tool is IRC Section 911, the Foreign Earned Income Exclusion. It is not automatic. You have to actively choose it, and it's capped at a certain amount each year. These two paths are on different planets. They never, ever cross.
And let's get really precise about this because the law is crystal clear. The language in the regulations, specifically 26 CFR Section 1112-1, states this exclusion is only, and I mean only, for members of the armed forces. The IRS has spelled it out time and time again in their own internal memos. If you're a civilian, whether you work for the government or a private company, you cannot use Section 112. End of story. That's the legal bedrock right there.
You know, this slide hits on another huge point of confusion. Lots of contractors see hazard pay or danger pay on their pay stub and think, aha, that's it. They assume it's the same as the military's hostile fire pay, which does come with tax benefits. But it's not the same thing at all. For you, as a civilian, that extra pay is just regular 100% taxable income. It gives you zero special tax status. Okay, so if Section 911 is the only tool for contractors, why couldn't they always use it? Well, for a long, long time, there was this massive legal obstacle that trapped thousands of contractors in a total high-tax nightmare, even while they were deployed. The entire problem came down to a single, tricky word in the tax code, abode. See, to qualify for the Foreign Earned Income Exclusion, you had to prove your tax home was in a foreign country. But the law also had this little catch that said you couldn't qualify if your abode, which basically means your true home, your family ties, your economic life, was still in the United States. And this is exactly how the IRS used that rule against contractors. They went to court and argued, and they won, that because a contractor was living in a temporary container on a base, couldn't bring their family, and still had a house and bank accounts back in, say, Texas or Florida, their abode had never actually left the U.S. This interpretation, which they spelled out in memos like AM 2009-003, essentially slammed the door shut on tax relief for most combat zone contractors. I mean, this situation was just not sustainable, and it led directly to a huge legislative fix that completely changed the entire landscape for contractors. It was a total game changer. You can see the whole story right here. Before 2018, you had the Abode trap in full effect. Then, boom, February 2018, Congress passes the Bipartisan Budget Act, and tucked inside is Section 41116, which directly changed IRC Section 911. It created a very specific exception. That old abode rule no longer applies to people who are supporting the armed forces in a combat zone. That was it. That was the key that finally unlocked the door.
So now that the abode trap is gone, the path to tax relief is finally open. But, and this is a big but, it is not automatic. You have to follow a very specific set of rules to qualify. This is your playbook.
All right, the most important number you need to burn into your memory is 330. To qualify for the Foreign Earned Income Exclusion, you have to pass something called the Physical Presence Test. What does that mean? It means you must be physically present in a foreign country or countries for at least 330 full days during any 12-month stretch. Now, technically, there is another test called the Bona Fide Residence Test, but for a contractor in a combat zone, trying to use it is like walking through a legal minefield. The IRS is almost certainly going to argue your assignment is temporary, making it nearly impossible to prove you're a true resident of, say, Iraq. So here's the bottom line. The 330-day physical presence test is your only safe, reliable path to getting this tax break. So what's the prize for jumping through all these hoops? For the 2025 tax year, you can exclude up to $130,000 of your foreign earned income from federal income tax. That number gets adjusted for inflation every year. Now, if you earn more than that, you will pay tax on the difference, but you'll pay it at the tax rates you would have been in anyway, which is a pretty good deal. Okay, so how do you actually claim it? It's a two-step process. First, you give Form 673 to your employer. This is basically you telling them, hey, I expect to meet the 330-day test, so please stop withholding federal income tax from my paychecks. Second, and this is non-negotiable, you must file a tax return and attach Form 2555 to it. That form is where you officially calculate and claim the exclusion. Even if you think you owe zero tax, you still have to file. But what happens if you're forced to leave early? What if there's an emergency evacuation? Well, the IRS has a waiver for what they call adverse conditions. Every year, they issue something called a revenue procedure, like Rev Proc 2025-17, and it lists countries where that 330-day rule is waived if you had to leave. If your country is on that list, you can still claim the exclusion for the time you were there, even if you didn't hit that 330-day magic number. Okay, so you did it. You qualified, you filed, and your federal income tax bill is zero. That is fantastic. But listen up, because you're not out of the woods yet. The FEIE is a powerful tool, but it is not a magic wand. There are some major financial dangers it does not protect you from at all. Let's talk about the tax that never ever goes away, Social Security and Medicare. The Foreign Earned Income Exclusion only works on income tax. It has zero effect on FICA taxes. As you can see here, if you're a regular W-2 employee, you're paying 7.65% on every dollar, no matter what. But if you're a 1099 contractor, you get hit with a double whammy. Both the employee and employer half, which is a flat tax of around 15.3%, even when your income tax is zero. And finally, we have to talk about the state tax trap. Your domicile is your legal permanent home, and it is incredibly sticky. The law sees your deployment to a combat zone as just a temporary absence. You don't just stop being a resident of California or Virginia because you're working in Iraq. And the FIEE is a federal benefit only. It does nothing for your state taxes. So you can be in a situation where you owe $0 to the IRS and still get a 5-figure tax bill from your home state. So let's boil it all down. Let's do a quick recap of the most critical points. Number 1, the military's Combat Zone Tax Exclusion, IRC Section 112, is not for you. Number 2, your one and only tool is the Foreign Earned Income Exclusion under Section 911. 3, the 2018 Abode waiver is what made it possible for you to even use it. 4, you've got to meet that 330-day physical presence test. And finally, never forget, the FIEE doesn't touch your Social Security, Medicare, or state tax bills. And that brings us to the final and maybe most important thought. This idea that just because you're getting paid in a war zone, the money is tax-free, it's more than just a myth. It's a really dangerous financial fallacy. And you better believe the IRS is very, very good at correcting those kinds of assumptions. And they do it with audits, penalties, and a whole lot of interest. Knowing the rules isn't just a good idea, it's your absolute best defense.